Hey everybody, this is Eric Sandstrom with the Home Loan Heroes, and we're going to be talking about a topic today that has been pretty hot in the market, and that is called DSCR, or ICF, as I like to call it. So we're going to be explaining that program in detail, and here's a few of the points that we're going to be touching on. So one is going to be, what is the definition behind those acronyms? What does DSCR mean? What does ICF mean? These are all new terminologies that we're all not familiar with, especially as home buyers. So we'll be explaining that. How do DSCR loans and investor cash flow loans determine if you qualify for the program? What are the average interest rates right now for these types of loan products? What are the current issues with these types of loans preventing them from closing? I do quite a bit of these. And there's some things that I've ran into recently that I think is very important for people to know. And are there any alternatives to help qualify under these programs if the rent doesn't cover the mortgage? Okay, so we're going to be talking about all of those things. Please stand by for more information. All right, so let's start right off the bat with what is the definition behind those acronyms. What does DSCR mean? What does ICF mean? DSCR means debt service coverage ratio. Again, debt service coverage ratio. ICF, very similar, except a simpler term, investor cash flow. They both mean the same thing. DSCR and ICF, they want to see the rent cover the mortgage. Now, there's a couple alternatives to this program that we're going to be talking about later, but that's essentially what it means. So let's get into the next thing, which would be, how do DSCR loans and ICF loans determine if you qualify? Again, kind of like what I mentioned, as long as the rent covers the mortgage, you're good. We're not going to be looking at taxes. We're not going to be looking at pay stubs. We're not going to be looking at W-2s, any income docs we really don't care about for this program because it is an investment purchase and it's cash flow based. So if you claim a lot of expenses on your tax returns, we don't care. As long as the rent covers the mortgage, you're good. There are some programs that do no cash flow requirements, and those no cash flow requirements do require a little bit more down, typically about 30% when the program starts at 20. So if you put an extra 10% down, you don't have to worry about the property coming in and cash flowing. That's a way that I've been able to avoid cash flow requirements. How do you determine if the rents are going to qualify? Let's say you've got a lease agreement, and let's say you have an appraisal. The appraisal has what's called a market rent schedule attached to it, and the investor is going to go by whichever is less. So if the rent that came back on the appraisal due to market rents, let's say, was lower than the lease agreement, we would be using that. If, let's say, the lease agreement came in and was lower than the market rents and it's already occupied, that's the amount that we would be using. So it can vary drastically when it comes to how much income you're going to be able to show towards these programs to determine if you qualify. All right, let's get to the fun stuff. What are the average interest rates for these types of loan products? Now, they do jump a lot with these programs. There's 10 different investors. They all have different rates. Of course, it's our job to find you the best one, the one that's going to close the deal. And then also, the one that has the best pricing, right? So I did price one out with my favorite investor, who I close on average about 10 loans a month with them. And yesterday, for an investment purchase, DSCR, 20% down, the rate I would believe was around 7.75, and that was with a small extra cost around 1.5 points. So what I did was I priced it next to Fannie Mae and Freddie Mac to see what the difference was. And actually, today, the time that I'm talking about this video, our pricing is more aggressive on the no doc or lower doc programs than they are for the full doc. Now, what does that mean? Essentially, that means that there's more of an investor appetite to do these types of loan products instead of your full doc Fannie Mae, Freddie Mac loan product. So I think on average you're going to see, depending upon credit scores, anywhere from 7.625 to 8.5, somewhere around those rates. And they are 30-year fixed. It is not an adjustable rate, so it's not going to change throughout the loan process. Now, with these loans, there is what's called a prepayment penalty. Now, some states don't allow prepayment penalties, and pricing does reflect that. Other states, you can do a 3-year, a 4-year, 3-year, 2-year, 1-year prepay, and the interest rates will vary depending upon the prepayment penalty that you choose. I'd say about 95% of these loans that I'm doing on a 1-year prepayment penalty because I'm expecting interest rates to go down so that we can come back and refinance you guys into a more affordable payment. That would be the idea. That'd be the goal. Of course, we have absolutely no clue what the market's going to do, so we can look at different options to determine what's going to be best for you and your family. If you like this video, please make sure to like, subscribe, and comment. And then of course remember that we do lend nationwide. So pretty much anywhere you are in the country, we can help you out with a home loan. And our contact information is, of course, here on this video. We're looking forward to speaking with you. Bye.